Okay, so chapter 6, deductions and losses. So we're going to talk about what we're allowed to deduct and what we're not allowed to deduct. And the things that we are allowed to deduct, what is the extent that we can deduct them? So I'm going to pull up Form 1040. I'm going to pull up Schedule 1. I'm going to pull up Schedule A, just for examples. Oh, and also Schedule C. Okay. So if we talk about our Form 1040, all of our income and deductions for AGI are above the line. So we've got deductions in capital gains, we've got deductions in Schedule 1. The deductions in Schedule 1 go all the way back to here's Schedule 1. You've got your Schedule C, you've got your Schedule E. So let's go to Schedule C, for example. Schedule C, I've got income, I've got all these expenses. So all these other forms have all these other expenses. And there's so many forms that have income and expenses or deductions that, we're not going to go through every single one of them. We're going to go through some specific ones, okay? But if you look on your Schedule 1, your second page, these are all adjustments to income, right? Expenses, because you're a professor. I'm a professor. If I spend money, I used to, back in the day when you didn't have computers in the classroom, you had notebooks and pens and pencils. I would bring pencils to class. I'd buy pencils and bring them to class because some students didn't have any, or a book. And I used to be able to deduct all those costs on my tax return. Now it's limited to $250. Alimony paid. IRA, if you pay money to an IRA, you can deduct that here. If you had interest deduction, if you paid student loans and you had interest that you paid, you can deduct it here. So there's so many deductions out there, and so many of them are above the line, above the adjusted gross income line. They're deductions for AGI, for calculating AGI, right? But then you also have deductions from AGI, which is your standard deduction or itemized deduction, which is your Schedule A, your qualified business income deduction. We haven't talked about this line 13 before, but we're going to go through it today. So the first part of this chapter is we're going to go through the ideas of what it means for what are deductions from AGI and for AGI, which I just described. And we've gone through this before, right? The cash and accrual method, we've done this before. We've gone through a cash method when you have a sale and you haven't collected the money. You don't record that journal entry until you've collected the money. And I went through journal entries of sales and expenses on account and sales and expenses with the cash method. So we're going to talk about this in a little bit more detail of when you can use the cash method and when you can use the accrual method. Some disallowance provisions, things that you're not allowed to do. You're disallowed. You're not allowed to do them. What are they? Okay. So we always have a big picture. So the big picture today is Dr. Cliff Payne. He determines that the deductible expenses for his dental practice, a sole proprietor. Okay. Wow. That's Schedule C, right? Schedule C, sole proprietor, tells you it right there. Salaries, including FICA, $120,000. $5,000 haven't been paid yet. Building rent. Dr. Payne has a building and he's renting it out, paying $24,000 of rent a year. He depreciates his dental and office furnishings at $52,000 a year. He pays insurance, malpractice insurance, dental equipment insurance, et cetera, et cetera. He pays $22,000 a year. He pays dental supplies, $16,000 for the year. Office supplies, $3,000. Investigation expenses, $6,000. So the question is what of these is he allowed to deduct? And if he's allowed to deduct them, to what extent can he deduct them? Is any of these disallowed? Same thing with the next. Contributed to a state Senate fund, Tom Smith, $1,000. Contributed to a state fund to Virginia White, $1,000. Are those allowed? Can he deduct those? Legal expenses with a patient lawsuit. Can he deduct those legal expenses? A fine imposed by the city for improper disposal of medical waste. Can he deduct that? Now, GAAP rules are different than tax rules. Some of these things you can do for GAAP, but you can't do for tax, and vice versa. Dues paid to the dental society. Can he deduct those? A draw. Now, a draw is a distribution. So, for example, when you start a business, you might be contributing your own money to start that business. Like, you don't have any money in the business checking account because you haven't earned any money yet because you didn't start the business. So usually what you'll do is you contribute your own money to buy your computer or to buy your, printer or to rent your first space, whatever that is. So the money's coming from you. So you're contributing it to the business. Well, then when you draw down on the business, some of that's taxed and some of it's return of investment, right? We've talked about that before. So how much of this draw of 60,000 is a return on investment, but how much of it is earned after the return on investment has been paid out? So deductions for AGI, they can be claimed even if the taxpayer does not itemize. So that's everything above the line. Everything above adjusted gross income. If I've got deductions on Schedule 1, I can deduct them even if I don't itemize, right? These are all different line items. Now, for itemized deductions, there's certain ones, but they have some limits. So if we go to Schedule A and we look at our medical, the first line, medical and dental expenses, you put in your medical expenses, you put in your AGI number here, you multiply your AGI by 7.5%, and everything above that number is deductible. So let's say I have $50,000 of expenses. And my AGI on page 1 of my 1040 is $200,000. What is $200,000 times 7.5%? Do the math right now yourself. $200,000 times 0.075. That's $15,000. So what it's saying is I had $50,000 of expenses, but I'm only allowed to deduct $15,000 and above. So I'm only allowed to deduct how much? 35. Right? So there's some limitations. That's as simple as it is, right? There's some limitations that we're going to get to. Deductions from AGI, that's on same thing, on page 1, right? From AGI. This is AGI. What am I deducting from there? My itemized deductions and my qualified business deductions. There's only 2 lines. Those are my from. Okay? If you're going to pick your itemized, it must exceed your standard. So common deductions for AGI. What is the common word here? Property held for business. Property held for business. Property held for business. Business, business, business. Okay? This here, as you're a teacher, you're allowed to deduct up to $300. It was $250 last year, so it's $300 this year. It'll change each year. So depending on when you're listening to this, it's going to change each year, right? So those are above the line. These are all on your Schedule 1 that I just described to you. Student loan interest, contributions to a retirement plan, health savings plan. These are all examples of deductions for AGI that are on Schedule 1. Section 212. And then we're going to talk about Section 162. The 212 are allowing ordinary and necessary expenses paid for the production of income, for expenses paid in determination or collection of tax. 212 is about income, rental and royalty income. Trader 162 is ordinary for carrying on a trade or business. So it's always, business expenses are generally always deductible, generally. What about these ones? Charitable contribution or gifts. It excludes these as expenses. So section 162 says charitable contributions or gifts are not deductible on the business part of the Schedule C of the personal return. Illegal bribes and kickbacks are not deductible for tax purposes. You're breaking the law. You have to pay a fine. You're not going to get a tax break for that expense because you're not supposed to be breaking the law. Fines and penalties, they're excluded from being a trade or business expense for your tax return. To be deductible, it has to be ordinary, necessary, and reasonable. It has to be an ordinary course of business. It's something that you would do in the business that you're in. Now, if you're in the business of selling chocolate, but then you fly all over the world and go to spas and say that's a business. No, it's not a business. That's not ordinary business. That's you taking a vacation and charging it to your business. It's necessary. You need to do it. Any prudent business person would do the same type of expense, and it's reasonable. Personal expenses. This is where we get to our Schedule A from AGI. Now, there are some personal expenses that you will see on Schedule 1 that I just told you, your student loan interest expense. That's a personal expense. It's on your Schedule 1. But the majority of what you can get personal expenses for are on from AGI, which is your Schedule A. Your medical expenses, taxes that you've paid, taxes or points. Sorry, taxes that you've paid, your property taxes, mortgage interest or points. So people don't understand what points are. So let's pretend this is about points. Okay. So let's say you're going to buy a building and you need a loan and the building is worth $300,000. So you go to the bank and say, I need a loan for $300,000 to buy a building. The bank's going to say, no problem, but we're only going to give you a loan for $240,000 because a bank will never give you 100% for a property because they want you to invest as well. They said, we're going to give you a loan for $240,000 if you put 20% down, and you're going to pay us back 7% interest. Well, every year on my tax return, the interest that I pay, I'm going to put here. Interest that I pay, I'm going to put here at the end of the year. Well, 7% is a pretty high interest. Can you offer, I might say to the bank, can you offer me a lower interest rate? And the bank might say, yeah, we can order you a 6%. We can offer you a 6% loan, but you'll have to buy that point because we went from 7% to 6%. So you can buy that point. So basically you're going to do a calculation to see what a 30-year 7% loan would charge in interest, and then do a calculation to see a 30-year loan, 6% interest, what that amount is. And if you look at the difference between that 6% and 7% 30-year loan, what is the difference between the two of them? If that amount is greater than the amount you're going to pay for the point, in this case, $1,000, then you might want to pay for the point because you're going to be paying less interest over the 30 years because your monthly payment would be lower at 6%. And also over the 30 years, you're going to be paying less. You might buy that point. So if you buy that point, you put the interest that you paid for the year plus $1,000 that you paid for that point. That's what a point is. Okay. Gifts to charity, casualty losses as long as a federally declared disaster area. This is new as well. It used to be that if you had a casualty loss in your house, like a flood or a fire or something like that, you would get a deduction for whatever the insurance did not cover. But now that's all changed. The only way that you can get a deduction on your tax return is if it's been declared a federally declared disaster area. That caveat is a new caveat. All right, so that's our examples of itemized deductions. 165, business and non-business. Again, loss is deductible in occurred in trade or business, entered into profit. But you also may deduct casualty losses from fires and storms as long as it's a federal declared disaster area. That is what I just described here on Schedule A. So we're going to talk now about our qualified business income deduction. What is this about? This is something new. Here on yours, it's been in here since 2018. Qualified business income deduction. So let's say I go about and I had $100,000 Let's say I had capital gain of 5,000. I had income of 20,000 for my qualified business. 25. That's $125,000 as my adjusted gross income. 100 plus 5 plus 20,000. That's my adjusted gross income. I'm single. I don't itemize. I'm going to take the 13,850. I don't know this number yet. So I add these together, 13,850. What's my taxable income? Try to calculate that now. Well, and then my taxable income is 1,111,150. Okay. That's just me filling in numbers. I'm making up the numbers. Okay. So we're going to go through here on the Excel file. You'll see I have all the rules here, and I have examples that we're going to use with the different steps, and everything's kind of written in here. Here's another example of the cash versus accrual that we talked about before. It's just a summary. Okay, so let's go back to this QBI. So I'm going to walk through these slides, and then I'm going to go back to the Excel file. So listen to how this works. If you have a qualified business income, which we're going to talk about what is qualified business, and you have income from there, the IRS is going to allow a 20% deduction. But that 20% deduction is going to be calculated by this way. The lesser of 20% of your qualified business income or your modified taxable income. So once you do the calculation for your modified taxable income, and then you do qualified business income, whichever is the lower amount, you're going to multiply that by 20, and then that number goes right here. So let's go over to this file. In general, the lesser of. So I'm going to say my qualified business income is $20,000. 20% of $20,000 is $4,000. And I made up the number, and my taxable income, let's change it here. It's 111,150, right? $111,150. I have to subtract out any capital gain, which I had a $5,000 capital gain, right? That was my capital gain, 111,150. That's my capital gain. So 111,150 minus $5,000, I get 106,150. I multiply that by 20%, I get 21,230. Which is the lower number, 4,000 or 21,230? Which is the lesser number? 4,000. So then I'm going to put my 4,000 in here. And then this number is going to change to 17,000. 13 plus 4 is 17. And I'm going to subtract 11, 10,987. This is going to be 107. That's how you figure out your qualified business deduction, right? However, this is step one. This amount is phased in over $100,000. If your income is greater than $100,000, you just do step one. If your income is greater than 340, you have to do step two, which is down here, which is down below, which we're going to get to it in a second. But I want to go back to the slides. What is qualified business income? Qualified business income is your ordinary income less your ordinary deductions from your qualified trade or business. It does not include wages, capital losses, dividend, or interest income. It's your ordinary income. What exactly is the business that you're in? What is the revenue you generated from the actual business? And what are the expenses you had to sell those products? It's ordinary, nothing else. All the deductions that you have must be attributable to the trade or business they're taken into account. Some examples are self-employment tax deduction, right? Self-employed health insurance, any deductions for contributions to a qualified retirement plan. All of these are examples of business deductions. If you had a qualified business loss in 1 year, you have no QBI deduction. This QBI deduction here would be 0. But you can take that loss that you took and carry it forward to the next year to reduce your QBI, but you can't go below 0. So now the next part, the limit. If your taxable income is more than $383,900 or $191,500, the numbers changed here, right? 383,900. $83,900 or $191,950 if you're single. This changes every year. So look to see what it is for this year. 383,100. 900 and 191,950. 191,950. Okay, those are your two amounts. So if your taxable income before the QBI deduction is more than 383, so if this number, before I calculate this number, if this number is more than 383 or 191 if I'm single, my QBI cannot exceed the greater of. So that $4,000 that I did, that $4,000 cannot exceed the greater of this and this. So let's go to step 2. If the taxable income more than blah, blah. So let's say I have some facts here. My taxable income before everything is 345. I'm going to change that now to 390 because the information changed. It's 390. 390. So my taxable income is greater than the 383, 390. My W-2 wages for my business were $75,000 for my qualified business, from my qualified business. My unadjusted basis, which is the second part here, unadjusted basis of all qualified property. Is 120. My capital gain is 6,000 and my QBI, the income that I earned from my business, was $70,000. So we're going to do step 1. My qualified business income is $70,000. Got it right here. Times 20% is $14,000. My modified taxable income is taking my taxable income of $390. I gotta change that to $390 now. Subtract out the capital gain of $6,000, I get to $384. $384 times 20% is $76,800. Which number is the lesser of? Step one is you take the lesser of these two. Which one is the lower number? This is the lower number. This is the deduction, $14,000. So now the question is, okay, if my income is more than $383, this deduction that I'm taking, which here I have is 4,000 because we're using different numbers now. This $14,000 cannot be greater than this or the sum of this and this. So let's figure that out. So what's 50% of the W-2 wages related to the qualified business? Well, my W-2 wages are $75,000. So $75,000 times 50% is $37,500. Or the sum of this and this, 25% of the wages. So 75,000 times 25% is 18,750. 2.5% of the unadjusted basis. My unadjusted basis is 120. 120 times 2.5 is 3,000. 18,750 plus 3,000 is 21,750. I change the numbers. Which number is greater, 37.5 or 21,775? The 37.5 is greater. Is my $14,000 greater than 37.5? No. So my $14,000 deduction is good. Now, let's pretend that the calculation's different and I say that my deduction's actually 76,800. Does that 76,800, is that greater than the greater of this or this? Well, the greater of this or this is the 37.5. So does the 76,000, is that greater than the 37.5? Yes, it is. So I cannot take the whole $76,000 deduction on my line 13. So what do I have to do? I will take the 37.5 as my deduction because it's limited to this number. So I can only take 37.5. Once a married couple has taxable income over $483,900, the whole entire thing is in play. All of your W-2 wages and capital investment and everything is in play. $483,900. $241,950. Then the W-2 wages, they're going to be put into the calculation. Okay, so that's what a QBI deduction is. What is qualified business income? It means that any trade or business that you're working in other than these. If you're working in health, law, or accounting, that is not a qualified business. Actuarial science, performing arts, it's not a qualified business. Consulting, athletics, financial services, these are not qualified businesses. So if you have a side business doing any of these, you will not get a qualified business deduction for them. This is what your format for your 1040 is. Now, it's a little outdated because the Schedule E and Schedule F should all actually be moved over here to the right because they flow into the Schedule 1. That's something that's changed, and they never updated this slide. So I want you to pause this, and I want you to tell me what is Angel's AGI. You're going to pause this, do the calculation, and then come back and do the answer. All right, welcome back. So had gross income of $38,000 and had the following expenses: charitable contribution of $20,500. We're asking for AGI. So they're asking you, what are the deductions for AGI? Charitable contributions are on my Schedule A. So that's from. Taxes on my home, that's from. Legal fees, from. Medical expenses, from. Penalty on or early withdrawal, that's on your Schedule 1, that's 4. So it's the 38,000 minus the 200 is your 37,800. What method of accounting are you going to use? Cash or accrual? By the way, in this Excel file, I have some more examples for you to do yourself. You can just delete the numbers. Here's another example. Delete the numbers. Here's another example. And do them on your own. Use this Excel file to change the numbers to do the calculation on your own. Cash versus accrual, right? Accrual, I'm going to record accounts receivable. I'm going to record accounts payable. On the cash method, when I have a sale, there's no entry made. You make a note on a side list because you haven't received the cash. On a cash basis, you're going to not record the journal entry because you have not paid out the cash. That's the difference between accrual and cash. Now, what are the requirements? I want to use the cash method. What are the requirements to be able to do that? The accrual method is used for sales and cost of goods sold if inventories are an income-producing factor. Exceptions are provided to taxpayers meeting the average gross receipt test. So in 2024, if your average gross receipts for the prior 3 years is not over $30 million, you can use the cash method. A lot of times people want to use the cash method because they have a lot of sales, but they have not received the cash yet. So they do not want to record the sale because they cannot pay the taxes on it because they have not received the cash yet. Especially if they have high sales prices, high sales inventory. Accrual method, we all know this, all events tests, economic performance tests. The deductions will be claimed only when all the events have occurred. Met when all the services is actually performed. These are what you learned in Intermediate Accounting 2, the revenue recognition chapter. There was the 5 questions. What's the specific performance? What is the method of payment? What are the specific performance obligations in the contract? That's what this is talking about. There are some exceptions to the economic performance test. What if you have a recurring item? A recurring item would be something along the lines of, for example, I had a client that was a construction company and they bought wood every week. So instead of having an invoice, signing a check every week, they got billed every quarter, but they received the shipment every week. So it's a recurring item. You don't have to worry about the economics performance test with regard to recording the income or not recording the income, because you're not going to accrue that item. It's not material enough because in the current period, you're going to wind up paying for it within the month because you pay for it monthly or quarterly or something like that. The 12-month rule. Capitalize an amount means I put it on the balance sheet. If I don't capitalize something, I put it on the income statement as an expense. So if I buy, let's say I buy these and I sell them, right? I don't have to put these on my balance sheet as inventory if I'm always going to sell them within that year. I can just do it as an expense. So if you're going to have prepaid expenses where you put the prepaid expenses on your balance sheet or capitalize them, but you're going to pay them within the 12 months. Instead of putting the prepaid expense on your balance sheet and then expensing the piece of it every month, they say, you know what, you don't have to capitalize it. You can put the whole amount on your income statement because by the end of the year, you're going to have paid them all off or you're going to use off the expenses. So it's not really a big deal. Time value of money. You can read about those, read about that. Disallowances. The tax law disallows deduction of certain types of expenses for different reasons. They might restrict the taxpayer's attempt to deduct certain items in reality that are really personal expenses. Is this actually a business that you're in, or is it a hobby? You know, I'm making bags. Is that really a business, or are you just doing it because you like making the bags and you're doing it as a hobby? So there's a disallowance that would happen if you have a loss on a business that's really just a hobby. So if I'm doing a hobby of making bags and I spent $2,000 last year to buy all the materials to make these bags, $2,000. And then I sold them for $1,500. I have a $500 loss. Well, is that really, am I in it for the business, or am I in it because I really like to do it and I like people having my bags? So there are specific disallowance rules that if it's not considered a trade or business, it's that actually it's a personal hobby. Deductions for certain specific expenditures are against public policy. If you have a penalty or a fine or a bribe or a kickback, those are disallowed because you're breaking public policy or laws. They're not going to give you a deduction for breaking the law, so they're not deductible. So in the big picture, Dr. Payne had not instituted proper procedure for disposing of medical waste. He then got fined $3,000 by the city. He believes that fine should be deducted as an ordinary expense. Due to public policy violation, the $3,000 is not deductible. Legal expenses incurred in defense of civil or criminal penalties. First of all, it's got to be from a trade or business or income producing. To deduct the legal expense, you must be able to show that the origin and character of the claim are trade or business. Personal legal expenses are not deductible. They have to be ordinary in the course of business. If you have an illegal business and you have expenses, they're not deductible. Section 162 disallows fines, bribes, etc. from being deducted. But what's ironic is drug dealers are allowed to deduct for ordinary and necessary business expenses incurred in their business, except for cost of goods sold. So there are drug dealers out there that are making money that are putting it on their tax return. We know that Dr. Payne contributed to 2 state senates. No business deductions allowed for direct or indirect payments for political purposes. Lobbying expenses to influence local and state and federal legislators for high-ranking public officials are not deductible. That's considered bribing. 2 exceptions. If you're doing it to monitor legislation, not try to change legislation, but to monitor it, you can deduct it. Or if the amount is less than $2,000, you can deduct it. So Dr. Payne made political contributions to the state campaign for Tom Smith, $1,000, Virginia White, $1,000. He made these contributions to encourage these senators to support a new bill that's beneficial to the state's dental practice. Therefore, he assumed that these would be deductible business expenses, but they're political. They're not deductible. He will receive no benefit from them. He made contributions to the Dental Society, trade associations for dentists. The trade association says 70% of its dues are allocated to lobbying activities. So whatever he contributed to the dental, 33% of it is allowed to be deducted. 30% is allowed to be deducted because the rest of it was for lobbying activities, which are, as we said over here, not deductible. Executive compensation. I'm a CEO, I'm a CFO, I make a lot of money, right? Well, if you're a CEO or CFO and you make a lot of money, I'm the owner of the company, I'm the board of directors, and I'm paying you a lot of money. So my company, when I pay you, we have a deduction on our books and records for salary expense. Well, the IRS has said the deduction for excessive executive compensation is limited. If you guys pay, you're the CEO, if I pay you $10 million, I can only deduct $1 million as as compensation. Okay, so the deduction is subject to two limitations. The compensation is subject to reasonable requirements. And for publicly held corporation millionaires provision, the deduction for compensation paid to covered executives is limited to $1 million. So I'm giving you $5 million or $10 million, but I can only deduct $1 million on my books. The other $9 million I can't deduct on my books as an expense. The covered employees are the CEO or CFO during the year and 3 other more highly compensated executives. And they're capped at $1 million. Now, this used to be just their salary, and it did not include bonuses. The $1 million was just their salary, did not include bonuses. But then that changed. Anything between 2017 and 2018, as long as there's no mature, it was, like I said here, before 2018, the $1 million excluded commissions and bonuses. Performance-based compensation is bonuses. So any contract before that amount is grandfathered in. So if you have a contract before 2017 and you receive money, that's commission. It's only on the commission. Anything after that is now going to be based on compensation, commission-based, performance-based. The $1 million limitation is for, so you're the CFO. I gave you $10 million of a salary. I can only deduct $1 million. I also gave you $20 million in bonuses. I can deduct the $20 million of bonuses prior to 2017. But now, after 2018, if I gave you $20 million for your salary and $20 million for your bonus, I can only deduct $1 million in total because they've expanded it to not just your compensation, but also to your commission and your performance-based. Investigation of a business. We know that in the big picture, he was investigating a business. So what does that mean? When you're looking to investigate a business, it means you want to either buy that business or you want to buy a part of that business. And generally, there's 2 parts. Either you're looking at a business that will be good for your business. So he's a dentist. So he might be investigating, another dentist to take over that dentist to have, a second location or something like that, right? So if you have investigative expenses where you're going to go and investigate, you're going to hire a lawyer, they're going to go and look at the firm or the other dental place, because this is a dentist, and they're going to look at their books and records, and they're going to investigate, is this company feasible to enter into business with me or expand into business with me? So I travel to the place, engineering, architectural, whatever, all of the services that I have paid to investigate, is this company something that I want to invest in to bring them on board because I'm a dentist and they're a dentist and I'm going to own their stuff, right? The tax treatment of these expenses depends on these 4 things. The current business, if any, of the taxpayer. Our taxpayer is a dentist. The nature of the business being investigated. Is it a dental place or is it a spa that he just wants to own to make money on? Does that work with ours? The extent to which the investigated had proceeded. How many expenses did you have? It's got to be reasonable. Whether the acquisition actually takes place. So, if the taxpayer is in business that is the same as similar to what's being investigated, the investigation expenses are deductible. Taxpayer result is the same whether or not the taxpayer acquires the business. So I'm a dentist. I go look at another dental shop. I do all the investigation. I do not buy the location. I can still deduct the investigation expenses because the 2 businesses are the same. I go and look at another dental shop and I do buy the business. All those investigation expenses I can deduct because I bought it. So when it's the same type of business, I can deduct those expenses whether or not I buy the business. When the taxpayer is not in business with that type of, so I'm a dentist and I go looking at a spa. I want to buy a spa, maybe. Has nothing to do with the business that I'm in. The tax result depends on whether the new business is acquired. If it's not acquired, all investigation expenses are non-deductible. If it is acquired, the investigation expenses must be capitalized as a startup expenditure and put on your balance sheet, and then you deduct it as startup expenses. Okay. Now, I actually know a dentist that bought a spa and then he moved his location into the spa because he wanted to have his dental location be more spa-like. That was for his business. So you want to look at the reason for why they're buying the business, not only what type of business that it is. So if acquired, they may elect to deduct the first $5,000 of expenses currently, and anything over that can be amortized over a period of 180 months, no less than 180 months. When arriving at the $5,000 immediate deduction, a dollar for dollar reduction must be made for those expenses in excess of $50,000. So a taxpayer is not in business. If it's not acquired, cannot deduct anything. If it is acquired, they're going to follow these rules. They can deduct up to $5,000 of the expenses, and anything over the $5,000, they're going to amortize, and anything over 50, they're going to do a dollar for dollar reduction. So we go back to the big picture. Dr. Payne believes his administrative and business skills can be used to turn around his dental practice with revenues that have been declining. He investigates Teeth Restoration, a local dental practice, for the sale. Expenses are paid to the consultant and accountants for $6,000. He determined that the Teeth Restoration would be not a good investment, so he did not buy it. Can he deduct the $6,000? It's the same type of business. He did not buy it. The answer is yes, because it's the same type of business. You can deduct the $6,000. Hobby losses. In more detail, you're active, but you're not entered into for profit. You're basically personal pleasure, like raising horses, operating a farm, used for a weekend residence. You know, it's not something that is your main business or your second side business that you want to make money from. If the activity is not engaged in for profit, the hobby loss rule applies. Your hobby expenses are deductible only to the extent of hobby income. Oh, I have an example here. I'm going to change the slide number. So this is $47 to $52. 47 to 52. So I gave you examples. I'm a dentist. I wanted to look at another dental practice. I spent $55,000. I don't acquire it. I can deduct the $55,000. I do acquire it. I can deduct the $55,000. I'm a dentist and I want to look at a spa practice. I spend $55,000. I don't acquire it. I don't deduct it. I do acquire it. I have a $55,000 and I elect to deduct $5,000 up to, and I amortize up to the $55,000. I'm a dentist and I want to look at a spa practice. I spend $52,000. I don't acquire it. I can't deduct anything. I do acquire it, $52,000, and amortize the $2,000. Okay. But I had hobby losses in here for you. So I have hobby revenue of $2,000. I have expenses of $500. So my net income equals 200 minus 5. you are going to record that income on your tax return. Well, in the next year, you had $2,000 of revenue and you had $2,500 of expenses. So you have a loss of $500. You cannot deduct that loss. This is going to be year 2021, 2022, 2023. So the next year, you have revenue of, again, $2,000. And this year, you do use cheap materials. This year, you use expensive materials. And this year, you decide you're going to go halfway. So you go to 1,250. So it's equal 2,000 minus the 1,250, which is 750. Well, I am allowed to carry forward the loss. So equals the 500. Now I have 0. I don't have to pay taxes on 750. I'm going to pay taxes on 250. So I had income. I pay taxes on that. Next year I had a loss. I'm not going to use that loss, but the following year I'm going to carry forward that $500 and use it against income, so I have to pay less on less income. That's how hobby losses work. And you can read as to the different factors of what considers a hobby. Rental of a vacation home. Okay, rental of a vacation home. You can have both personal and rental use of a vacation home. So let's say you live in your house and you get enough money to buy a vacation home, a summer house. Well, maybe you have that summer house and you never rent it out. You just use it for yourself. That's one thing. That's a personal house. Can't deduct anything for that except for mortgage interest sometimes, depending on the amount that you make on your first. Maybe then the second option is you use it sometimes and you rent it out sometimes. Well, how much of those deductions are allowed if you rent it out? If you rent it out for just part of the time, you can't deduct all of your expenses for the house if you only rent it out part of the time. So the rental expense may be limited to rental income if it's primarily used for personal purposes. So if this vacation home is mostly used for you, then you can't deduct those expenses. You can deduct them up to the income to make yourself have 0. But if you use it for vacation home is for business, you're going to figure out the tax treatment. And there's 3 possible tax treatments. The vacation home treatment is dependent upon the relative time the residence is used for personal use versus rental. Primarily personal use is the first slide. Primarily rental use is the second slide and the third slide. Okay. So primarily personal use, less than 15 days. If you use the home for personal use for less than 15 days, no gross income is recognized from the rentals and no deductible rental expenses. Mortgage interest and real estate taxes are treated as if a personal residence. 15 or more days, the treatment depends on the amount of personal use. Primarily rental use. If you rent it for 15 days or more and personal use days are not more than 14, or 10% of the fair rental days, you allocate the expenses between the personal rental days. So if you rent it for 15 days or more, and your personal is not more than 14 or 10% of the fair rental, then you allocate the expenses between the personal and rental based on the time that it's there. Records. If you're doing, even though you did the deduction, even though you paid it out, please email me.